Morning.
Hey, good morning. Let me fix my headset. I'm glad you said something.
Hello, 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 hello.
Why is this not working?
I am here. Can you hear me? Yeah.
Let's see. All right. Can you hear me yet?
Yeah.
Oh.
Loud and clear.
Perfect. All right. Let's get this party started. It is a new quarter and a new fiscal year. So with that being said, right, make sure you set your quarterly goals. Make sure if you didn't do it on over the weekend or sometime last week, what I like to do is before a new quarter, I like to look at all my executions from the quarter before, all my trades. I manually add them up. I manually look at the losses and they reflect on how I want to trade for the next quarter, right?
Absolutely.
I build the trade plan for the quarter because believe it or not, I like to trade quarter to quarter, not day to day, not month to month, but quarter to quarter. And it's extremely hard as a younger trader to get to that mindset.
Yeah.
But eventually you will. Just like, if you're a business owner or anything like that, you're going to be looking at your sheet every quarter, right? Because you don't want to make too quick of shifts to your plan. You want to give your stuff room to breathe, right? And I didn't change my workflow process whatsoever that we do in the morning, but I did change some of my how I was going to execute for this quarter. And guess what? I won't change it. It doesn't matter. I won't change how I'm going to trade this quarter unless I meet certain circuit breakers, like negative circuit breakers. Then I will definitely, I'll go back to the drawing board, and I will, stop intraday for the whole rest of the quarter and spend the rest of the quarter refining and back testing and all that. And that's the kind of stuff that professionals, that you're in one of the craziest parts, statistically, you're in the craziest parts of investing and trading the intraday. It's the noisiest, it's the most confusing, it's the hardest way to squeeze a buck out of the markets. And you truly, everything's skewed against you. It's not meant to be skewed against you. It has nothing to do with you, but that's why it just is, right? So with that being said, you need to have these circuit breakers to tell you, to stop. Just stop.
Question.
Go back to the drawing board because a lot of you guys are trading prop accounts. You're not trading real money. But you even need to get into this habit with the real money because if you're trading your money, and I'll answer your question in a minute. Let me finish this thought. If you're trading real money, let's say you have 20,000, 100,000, 10,000 in a live trading account, and it's specifically designed for you to intraday trade. Are you going to let 90% go away without saying, whoa, stop, let me redesign and figure out why this isn't working and put some stuff in place? Don't get wrapped up in the mindset that you can blow accounts and then, just buy a new one, because the goal in 5 to 10 years is for you to be trading your capital. I would hope it would be.
Yeah.
Right. And in order to be trading massive amount of prop, right? So that's why we have these circuit breakers throughout the quarter to tell us, hey, you've done intraday. Like you've hit extremes. You need to stop for the quarter and spend the rest of the quarter, testing and refining and rebuilding and stop trading your capital. And if you don't have that kind of discipline, I'm telling you, you're the noisiest, dirtiest, craziest part of investing and trading. That's the intraday. It doesn't mean you should turn off your swing trades for cyclical and cyclical parts of your portfolio, but for intraday, it's always wise to have that. All right, what was your question, brother?
Yeah, so with the circuit break, I had some bit of time over the weekend and was working on a back test, quite a rapid one, and it got me thinking because of the I was basically using trading view and of course the contracts on that, and because I was on a 1 minute chart, I'm kind of limited to certain time blocks. But what I had was I had really good data and good results, but it made me think, well, at what point, if something is deviating from the norm, what would be, as you put it, there would be a circuit breaker in that instance? And my question to you is, Mickey, is your circuit breaker both kind of
consistent losses in a row?
Okay.
So like I have a system that showed me that like the max consecutive losses for the last 10 years was 6.
Right.
So if that system is hitting 10 and 11 consecutive losses, it's time to circuit break, redesign, figure out what I need to incorporate to fix that, or it's a percentage loss, right? And I have a specific one tailored designed to me.
Yeah.
Rule breaks, right? So like if I break 3 rules in the whole quarter, I'm done. I don't care if it's position size rules.
Wow.
I don't care if it's entering the markets when I'm not supposed to be. I don't care. Like if I break 3 of my rules in a quarter, like I'm done intraday trading for the rest of the quarter, or I'll put myself in timeouts. But like I'll give myself one timeout that will last a week. But if I do it again, like I'm done for the quarter, because those are clear signs that something's bothering you. Something is, like wrong with your stuff, and that needs to be addressed.
Yes.
It's like you guys saw me in January. No, it was February. I broke rules, right? And I removed all my cash out of the discounted broker and put it in a regulated broker, so I would not be able to over position size anymore. You are your own boss, and you have to be an extreme risk manager if you're trading your funds, because nobody else is going to. And that's why, like, I'm an advocate of you have to be extreme on yourself.
Yeah.
Like, if you still want to allot funds during that quarter, like you don't want your funds sitting there, go to your swing trading strategy and just put all your intraday cash in a position. The SPY, non-leveraged, Apple stocks, Tesla stocks, whatever, right? Just have it working, but don't be touching it. And then remove it the next quarter, and but like this is the stuff that nobody talks about that really sets you up for success, right? When Oliver Kill, listen, like, and one day I'll have him on here, and he'll tell you when he was competing in the Equity World Trading Champion in 2020, he had a really rough end of Q3, right? Where he hit circuit breakers, he hit, like he was not doing well and he was losing the competition, right? And it was at the point of Q3, he literally took 2 weeks off. All of his competitors, and even he would tell you he thought he was like an idiot for doing that. He's competing in this Equity World Trading Championship, and it's the fourth quarter, and he took 2 weeks off. And he will tell you that was single-handedly the reason he was able, other than responsible position sizing and sticking to his process and all that, he'll tell you that was single-handedly the reason he had the extra drive to go into the Q4 and just destroy everybody, right? And he won the Equity World Trading Champion, which is way harder than futures or Forex. Because there's 7,000 companies, and not only do you have to get the direction right, you have to get, the industry group right, you got to get the sector right, you got to get the sub-industry group right, and you got to get the companies within those sub-industry group rights at the right time. And so there's a lot more yes/no variables in the equities than there are futures, right? Futures, you need to get, the direction right, make sure you position size correctly. It's not that hard, right? But that's why we do these circuit breakers, and you're the one that has to hold yourself accountable.
Yeah.
You're the one that has to sit here and be your own risk manager. So don't be an idiot. All right. So now it's October. This is a new month, right? Due to T+1 life cycle of a trade. Today is the first trading day of the month. And we also know October 1 is the beginning of the fiscal year, meaning government budgets, central banks, anything like that, anything that has to do with the government, they started their new year today, right?
Yeah.
And one thing I like to do, because who controls the markets? Like, truly, you got the banks from the private side, and then you have the central banks and the other entities, right, that are synced with the government. And so what I like to do is I like to think of October 1st being the beginning of the year. And if we know we have a yearly candle, oh, nope, that's the wrong one. And for you ICT traders, you guys should appreciate this. If we know we have a yearly candle, right? And even the yearly candle, where's October 1st? Let me put this in the October bucket right there. And we know that if October 1st is the open of the year, we can see open, low, high, close.
Yeah.
Right? Let's do this year. Hey, my projection hit.
Cool.
All right, so let's do. All right, same thing with this year. This is a yearly candle, open, low, high, close. A lot of people think, and you can use October or you can use January. It doesn't really matter as long as you can see the vision clearly, right? So if we do January, January to January, this is what it looks like. Yeah. Now, you can do this years and years back, right? So I want you to sit there and figure out which one that you want to deal with, right? I like using October to October as because I know that it's a new government year, starts October 1st. That's when budgets get reallocated for every government entity across there. I know that the summertime, July specifically, August, September, budgets is talked about, like this is how much is left on our budget for every government entity out there. we need to spend the rest of this on our budget. So September and August, when we're proposing our new budget, like we can get the same amount of funds plus some funds from the government entity come October 1st. And I know, what does this have to do with the markets? Probably nothing, right? But this just letting you know the way I think and why I use October to October is the beginning of the year and nothing else. Because I like to pull my vision for the year. I like to be positioned in, like I should have a good identification of where January, because look, like we have these seasonality parts, right? And in my brain, I know that people who are prepping for the next year, it takes time for them to position. And this seasonality, summer seasonality that happens almost every summer, where it slows down, right? And then kicks off a new trend in October or November, right? They're positioning, right? New year opens, we move in the direction, new positioning in the January, February, March, finish the year. I've always told you guys there's like 2 to 3 good moves every single year, right? Usually the first one is in October or November going into January. Second one's between April and July. And, like you'll find some smaller moves like this, like this throughout the year. But at the end of the day, you guys shouldn't be allotting all your funds intraday. You guys should be investing. Yeah. You guys should have parts of your portfolio, whether it's your 401k, that's capturing that cyclical trend or that cyclical trend. Cyclical being 6 to 18 months out, cyclical being 1 to 3 months, right? All right. So if we know that October 1st starts today, right? Or the new trading month starts today, right?
Yeah.
And we know that I don't really care how you guys view it, I consider this a new year for the financial markets, right? Because if you go under the public company list and all the companies that are in this, go look at when their new balance sheet year starts. Does it start January 1st? Does it start October 1st? All right. Yeah. Just cool things to know, right? But all right, so let's move on. We are above previous month 50% and NFP Friday. So we know September 11th was the signal for us to target closing the month higher. We did that, right? We knew that on this month, whenever we have slowdown months or seasonality months, we know that we're looking for, is it going to be a monthly pullback, a quarterly pullback, or a yearly pullback? And we started going over that on Friday's video, how to tell the difference, right? We know that when we get below NFP Friday and previous month 50%, we're looking for quarterly pullbacks. What does that mean? That means once we get a daily close below NFP Friday and previous month 50%, so right here, this day, we got closure between both, we target quarterly lows.
Yeah.
Do I think there's stops or liquidity there? Absolutely not. Right? I don't believe in that, right? Because I know, maybe it's because of my work experience, that it takes these institutions 2 days to get through life cycle of a trade of their orders, right? They don't believe in stops and take profits. The big players don't. The traders the entities that trade for yield, they have stops and they have, take profits, like your mom and pop shops, your hedge funds. But like actual people who make markets and control markets, they don't do that, right? But why do we look for 60 days back, right? Once we get below previous month, 50% in NFP Friday, because this is from 90% of price and algos across any financial company. Even it doesn't have to be relative to Wall Street. If you own a tire and brake shop, a tire shop, right? And you can get tires of your inventory based off of previous month lows, or previous quarter lows, that's in discount, right?
Yeah.
So we know that those two entities make it a quarterly pullback. This time we hit quarterly lows. Let's look at this one, right? We get below NFP Friday. We get below daily closes below previous month 50%. We target quarterly lows. Boom. That's how you know it's a quarterly pullback. Now let's talk about a monthly pullback, right? We go to our weekly chart.
Mm.
We know that the weekly chart is to see what the market is pricing in. We're pricing in an economic news event or earnings cycle, right? This week, this month, what was the economic news catalyst that the market was pricing in? 50 basis point cut, right? So we know that we have between 2.5 and 5% to extend in a direction from this constant variable. Now, guess what? This is a 5 EMA. I don't use this EMA to trade off of. I use it as a constant variable to measure off of, because this is how far. Look at this little chart. I use it to describe to you guys.
Yeah.
These are how far monthly closes are. So this red little star would be the monthly close. The measurement, this red line would be that 5 EMA. The distance between the close and that 5 EMA is called the variance, right? And each variance, aka monthly close and the percentage it moved, can be square rooted and figured out, like if it's an average or if it's not, right? We use to see what the market's pricing in a very, very simple term, right? We say, hey, on the weekly chart, right, from that 5 EMA, what week did we start pushing the 2.5 and the 5%, and which week do we expect the market to slow down, right? So for example, let's do a couple of weeks, right? This month, we move 4.5 in week 2, and then we start the quarterly pullback, right? Right here, we move 6%.
Yeah.
Or actually 10% off this constant variable, and then we reverse, right? We start looking at this from a healthy market. We know that was a quarterly pullback, right? But if we know, we can measure if we're in a healthy market or a volatile market based off of this rule, right? If we're in a healthy market, we'll get in 2.5% to 5% around week 3 to 4, and we're spending week 4 to 1 slowing down and letting stuff catch up.
Mm.
And I don't mean the price that you see on these charts. I mean, things behind the scenes are catching up and slowing down. Like, we're slowing it down for a reason, right? So this month, we get above NFP Friday, previous month 50%. We extend 4.12. We slow down for week 1 and week 2. NFP Friday happens. We extend up for this month. We extend up to 3.89, right? Week 4 and week 1, we slow down, and then we take off again, right? These are monthly pullbacks. So now we've talked about monthly pullbacks. We've talked about quarterly pullbacks, right? And we know that right now we're starting a new month, right? We're above previous month 50%, and we're above NFP Friday. And this month we extended 3.77%, right? So now we can expect a slowdown. And if the market, we've already done the quarterly pullback that comes with the seasonality effect, and now we're expecting a monthly a slowdown for things to catch up and get fixed.
Yeah.
All right. So now that we know that, we also know that if we come over to this chart, all right, the ICT traders use Sunday opening price. So this is Sunday 18 to 1900. We know that the DR traders use Tuesday 9:30 to 10:30. And basically what they're trying to say is, where's the low of the week, right? Well, the ICT community has to draw out a new Sunday 18 to 1900 because we're going to use this to measure it. Are we putting the low of the weekend or the high of the week? So that's your new Sunday 18 to 1900 measurement, right? We know that the DR traders, their week doesn't end until Tuesday, 9:30 to 10:30. ICT traders, from this one, we went low, made the low of the week on Tuesday, made the high of the week on Thursday, put the close price in, and now we're waiting for Monday and Tuesday to play out. They show its hand around this Sunday and to show its hand around the Tuesday price, right? And one thing that is a great exercise for beginner traders, let me see if I still have it marked out. It doesn't look like I still have it marked out. All right, to get this step, right, go to crude oil, mark out the 9:30 to 10:30 on every Tuesday, put standard deviations on it, and look how many times crude oil makes the high of the month or the low of the month, right? We always return, well, 94% of the time for crude oil, we return to previous month first Tuesday in the next month, and we typically extend up to 8 or extend down to the -8 off of this first Tuesday. So you can do the same concept as a month-over-month view, right? So, but for now, this is our Sunday. We're below that Sunday. We're above the Tuesday, right? We still expect to look for low of the days from a statistical standpoint between 5 o'clock and 11 o'clock. One of these days, we're going to actually dig deeper into that and start testing deeper into that. Like, for example, like the ICT community will tell you, like you have New York, or you have London protractions, and all a protraction is what I tell you guys every time. To make it low of the day or the high of the day, which is the false move, you want to see destruction, right? So if I went on a lower time frame, this would not look like any of this. This would look like straight chaos to the downside and instant recovery to the upside, indicating that this would be a low of the day, and that this would be the daily wick right here, right? Right here, you can see that this is destruction followed by instant recovery, right? So we spent the whole overnight session going up just to recover down, right? This one, New York AM, actually this is around 8 o'clock in the morning. We go up to destruct down, right? I mean, we destruct up to recover down, right? All right. So far, we see that today, this would be, we have destruction to the downside. We found rejection off of the top of that Tuesday, 9:30 to 10:30, and we recovered it, right? So now we're going to go into our actual daily statistics. I got to be done by 6:30.
Okay.
All right. So the first step we do is generating market clues. What market clues? Let me turn off this because we don't need this yet. What market clues do we see?
Well, we've made a low beyond the previous 12 hours, and we can't
Previous
get it.
day.
Sorry?
Previous day. So this is the day. This is Friday.
Yeah.
So what is that telling us about the daily momentum?
To the down.
Mm-hmm.
We also couldn't. Yeah, and we can't get above the previous day's mid neither. Those are the two clues that I.
All right, absolutely. So we know that the generated market clues that the market has given us so far is that we took out previous day's lows, so momentum for the daily is shifted lower, and then we couldn't take out the previous day's midpoint. Exactly what Costa said, right? Indicating, and now just like we do with the weekly charts, we have to be able to think day of the week, right? Does this mean we need to short the ever-loving crap out of NASDAQ and we think the whole world's going to crash and burn? No, because we know statistically, right, if we put on this free premium kill zone and pivot, oh my gosh, he's got way too much shit on here. I'm turning some of this off. being a military dude and a dude who retired in the infantry, I love how the ICT community calls things kill zones and one shot, one like sniper this and all that. I love it, dude. Fits right in with my background.
Why not? Isn't it?
Like death and destruction, be aggressive. Let's go. All right, so we just set this up. We should go on the hour. We want to look back. That's not right. Oh, I know why that's doing that. If we look at, we set this freight indicator by TFO, and we want to see closest profiles. Right now it's set to 5, but if we put like 1,000, you're going to crash the system. It's going to look back at the last 190 weeks, right? And then you can see statistically the high of the week over the last 190 weeks, right?
Wow.
The high of the week has 34% of being conducted on a Friday, and that the low of the week has a 25% of being a Friday, right? So we know that the Friday is going to establish either the high of the week or the low of the week. We know that to be statistically true, right?
Yeah.
Now, we can see that the low of the week hits 21% on a Monday, right? And it hits 14% on a Tuesday. So if we put those two together, we get 35%. So we know that 35% of the time, the low of the week is on a Monday, right? If we look at the high of the week happening on a Monday or Tuesday, we can see around 29% of the last 190, right? Now let's break it down to, over the last year. So 52. 50, yeah. We'll do 56.
Okay.
Yeah. So we can see that Monday over the last year, high of the week, 36% on Fridays, high of the week, 23% on Mondays. Low of the week, 16% on Mondays, 23% on Fridays. So in our brain, we know that when we come in on a Monday, we need to expect the ability to either put the low of the week or the high of the week, right? So these are the 5 closest profiles using Sunday, opening and a moving average to align which weekly profiles in the past have done. This is like a Monte Carlos that's anchored off of moving average. I'm still trying to convince him that he should use, a different anchoring method or add a different anchoring method. We'll see if he goes for it.
Interesting.
Whether it's standard deviations or distributions, but we're still working through that, right? Okay, so we're not going to freak out and think that we need to short and hedge all portfolios that have any exposed risk to the long side, right? Now we're going to put our time-based probabilities on, which are midnight.
Yeah.
Settlement. Globex. How's your weekend? Everything work out? I know it is a really shitty situation.
Yeah, I spent some time with my mum yesterday to sort some stuff out. It's ongoing until the time comes to,
Yep.
So.
I'm sorry to hear that, brother.
Yeah. She was a good person. Very good.
It shows you, I think a lot of people got, and I feel sorry for them, but a lot of people got a intrusive wake-up call that life can be over in a weekend, right? Like, we had a hurricane come through and wipe out towns near me, and a lot of people died from that.
Yeah, that's not.
But it's unfortunate that happens, but then at the same time, for us that survive these natural disasters or whatever, right? It should be a wake-up call that life is short. There's no sense stressing about dumb shit. People are always fighting on Twitter. And it's like, guys, you guys know you're going to be dead in 40 years or on your deathbed. Like, go
No.
live your life. Like, what is the matter with you idiots? Right? All right. So now we've got our three prices on here. All right. Last week we put a new step into the system, and that new step said that we were going to start incorporating, and we're not far away from it, but we're going to start incorporating the RTH gap probabilities, right?
Yeah.
So right now we're going to use settlement, which is at 16.15, and throughout now to 9:30, we're going to be drawing this up or down based off of where price goes, right? But now I like to just do it like this. And then we're going to put the midnight snap on. We're going to come over here. We're going to click RTH. All right. And I must have messed that up somehow. Okay. So we need to put this outside of this day. So it needs to be like that. So when we switch over to the RTH, it's still, the fib still is there. See how the fib is there?
Yeah.
All right. So now we're going to go to the midnight snap. We need to put ourselves on the 15-minute chart.
Yeah.
So we get the proper amount of data points.
Yeah.
All right. First one is 50%. We're going to say on a Monday, the 50% has a 65% probability of being touched. So on the 50% of our fib, which is this blue line, 0, 25, 50, 75, complete, right? On the 50%, we're going to put our text, 65%. And we're going to go to the midnight snap. Right here where it says gap minimum retrace, we're going to put that on 25% now. And
What was
I lost this 65%.
Quick question. What's the session time set to? Just so we can all get that. I know you've already said, but just to confirm.
I don't know if this matters. Let's see.
All right.
I think it's just automatically coded because the session, if I can control it, would be from 8 to 12 because that's when I knock out most of my trading. Oh, I don't trade.
Yeah. Changing?
All right. It didn't change.
No.
No, it did change. It would change to 75%. Good call. So we know from 8 to 12, right? The probability of hitting the 25%. Wait a minute. Let me put this back on 50% to see if it changed. Because of course it changed because we put it on 25%. Nope, it didn't change. So you don't have to change that.
Okay.
So 25% is going to be 75%. %75% is going to be 54%. So we have this in the background, right? And so we'll have this on here, and then around 9:25, I'll have this on electronic trading hours, and I'll just set this in place based off of where price is, settlements to anchor, and then based off of where price is, this will either go up and down and meet it wherever price is. If it's down here, it'll be like this, and I'll put the probabilities in it.
Yeah.
All right. So let's talk about the next thing. We put our time-based probabilities on. We put our RTH probabilities on. Now we're going to put our structure-based probabilities on. So our structure-based probabilities are based off the 12-hour cycle, right? We know that this 15-minute high at 2000 and this 15-minute low at 215, they have probabilities, and every 15-minute high and low in there has probabilities with it, right? So This doesn't seem right. This was 75, not 25. Andy Cutland, thank you. All right, so now we're going to put the probabilities as structure-based probabilities at that high.
Got those.
And this is going to be at 2286, and that Mondays, am I right? My daughter always says that. She's like, Mondays, am I right, Dad? And I'm like, what? And now I say it.
Funny habits kids have that we pick up.
Yeah. I wish she'd pick up some of my habits. She'd be awake right now doing her homework. 5 o'clock in the morning.
Oh, you're pushing it hard.
Yeah.
Love it.
All right. So 2000 has 85% probability of being returned to over the last 2,000 days.
Yeah.
And then this 215 has a 82% probability of being returned to.
Yeah.
All right, so now we're going to get into the part of this where we actually incorporate. And listen, like this part is very shifty, but I've made it where you guys can still benefit from it, right? Right. So I have DR data that I've pulled plus DR data that gives me the ability to put in what Asia's done, right? From 1930 to 2030. We went short and stayed short. We couldn't break the mid of that. So we need to put our OU line for Asia OU, I mean. Yeah. Right there. London has gone short from the 3 to 4. We need to put that mid, right? Because that's where probabilities shift for what New York is going to do. And if this is going to be a London retraction, we're going to get New York AM reversal, right? That's going to happen. So these OU lines from Asia and London, those are the alerts of probabilities being shifted. And then the confirmation of that is going to be based off of, this London high and low, right? We have 2 possible scenarios right now, right? Scenario 1. And so the data that I use for this is data that I pulled and Costa pulled, and like most of the DR community has pulled their own data for this modeling. Or you can use M7's database in his system, right? Either way, I cannot share that because that would be completely disrespectful to his company and unethical, which is why I'm saying what did it take us? Take us 6 months to collect all that data manually, right? So maybe that's something that you do a little bit at a time, and all you have to do is say, hey, define your kill zone for the ICT-based traders or the regular-based traders, right? Define a time in the Tokyo markets as a range, and then measure what price does. So for example, this is 1930 to 2030. That's the range. What price does from 2030 to 02 is the variable. And then we go into 03 to 04, and what price does in relationship to that 4 o'clock to the 8:30, that's the variable. And you collect the data on that. It doesn't take that long. And then it's something that you'll use the rest of your trading career.
Absolutely.
We'll just go on Fiverr and find a coder and somebody who can code it up for you, right? I'm working with 2 degrees right now to be able to build a database that doesn't use these ranges. Me and Costa are doing some data collection to see if these are the most sensible times to be doing this around versus, and then collecting the data for it, right? That will tell her the way we trade even easier, better, right?
Yeah.
All right. So with that being said, we know that Asia went short, right? And stayed short until 0.2. It never broke the mid, never shifted the probabilities, right? So why is that important? Because until that, this would be the alert, right? Actually, London OU would be the alert that we're going to take out the London high, and that being the confirmation that we're going to the Asia OU, and that we more than likely will be able to get above previous day midpoint, right? So this will show us that momentum is shifting for the day, right? And confirming that this is a probability low of the day scenario that happened right there, right? So with that being said, scenario one, we cannot take out London high by 8:30, right? And below London high engulfs London, or above London low and 10:30 on. So what does this below London high mean? It means from 9:30 to 10:30, we're trying to find the probabilities of it being below 9:30 to 10:30, being below this London high. We're trying to find the probabilities. Does it engulf 9:30 to 10:30? Does it engulf both sides of this range? Well, we're trying to find the scenarios where both 9:30 to 10:30 is above this, right? And then we're trying to find the highest probable 10:30 on. So
yeah,
Costa with that, it should be Asia short true. It should be London just short. And then what are the probabilities?
Oh, just short.
Short true.
Yep.
Because we're saying that we can't take out the London high.
So it's 59% combined downside below.
Okay. What about engulfing?
22%.
Okay. What about above London low?
18%.
All right. And 10:30 on?
10:30 on is 49% long.
Okay. Scenario two.
Yeah. So
is going to be we take out London high before 8:30 and breach Asia's OU line. And then 9:30 to 10:30.
So session is now false
with London midline between 3 and 9:30.
Yeah. So
Does that make sense?
yeah, let me so that can happen after. So session, is it true or false in this instance?
It'll be false.
Yeah. Okay. So upside is 44%.
And now, hopefully you can see that you don't really need the data for this part. You just need to be thinking this way and knowing that these probabilities are there and shifting. All right, what's engulf? 28%. High? Below London high?
Below is 28%.
What is engulfing?
Engulfing is 28%.
So they're both 28%?
Correct.
All right, and what is 10:30 on?
10:30 on is short 52%.
All right, so now we've got the two scenarios they can play out. Let me fix this real quick. Right, we have our time-based probabilities, our structure-based probabilities. We know the day of the week and where we're looking, this is looking like it's going to make a low of the week scenario if it decides to make the low of the week probability on a Monday, right? But now, what are we doing? We're crossing the London OU line, right? Which is the alert that this London high is going to be taken out, and this London high is the alert. So this one, we cross over the London midpoint OU line. That's the alert. The confirmation is this London high. This London high is the alert that this Asia, and so forth and so forth.
Yeah.
Right. And it's all pointing to this being the low of the day scenario. So now what we're going to do is we're going to put on the vet. And this is what I mean. Like, you guys don't need, like, this is cool to be able to put the Asia, what Asia did versus what London did, and the variables and sync probabilities to it, but you still have the ability to pull the probabilities.
Yeah.
All right. So now, first thing we look at when we put the vet on, average weekly range over the last 8 is 936. We're currently at 141. So we've got 15% of the weekly range knocked out. Average daily range over the last 10 days is 290. We're currently at 141. We've knocked out 48% of the daily range.
Yeah.
All right. So now we're going to put our standard deviations around the Asia, and we're going to put the probabilities on them. Right. Let me go to the vet. Let me put in Sunday. Right. And now we can see that we came down and we touched the 2.5%. So now we're going to put the probabilities to the upside on.
So we taking these from the vet, or
no, we're going to take them from our database.
Yeah.
They can use the vet.
Yeah. So,
all right, and that's with
Asia short true, London short true. I guess.
Just do Asia short true, London short, leave true and false off, leave midlines broken, because it hasn't shown its hand yet. Like right now, it's higher probability that we come to a false, but we haven't even crossed over the alert. So we're just going to do neutral probabilities.
As we are right now, no problem. Yeah. Okay. So
one up,
60% true.
All right, 2.5.
42% true. 42%.
All right, 5.
25%. 25%.
Okay. And 8.
15%. 15%. 15.
Okay, so now we're going to look at this and we're going to think. All right, in relationship to Friday, right, what is the probability of us taking out the low of Friday and the high of Friday? If we remember Friday, this stayed very, like, number one, momentum couldn't shift to the downside. We barely got below it and we rejected back into it, right? And the fact that this was, so we know how we look at the average daily range over the last 10 days. This was a very low probability range day, right? So from high to low is 1%, 221. And if you remember on Friday, the average 10-day range was around like 350, right? And we couldn't even make 60% of that range. So we cannot just say, low of the days in, we should short every single rip, right? We have to keep our mind open to the fact that, yes, we take out the low. We have to keep our mind in the thought process of, yes, we have taken out the low and momentum is to the downside because we've got 2 days worth of lows taken out. But we also have to think there is a possibility that we come and take Fridays high out today as well, right? We've already hit 50% of the range, but we're going to keep that in the back of our mind, right? We're not saying that it's a higher probability because momentum is the downside, and we have to stay with the highest probable thought process, which is the downside from a momentum standpoint and from a statistical standpoint. The market has not shown its hand, but once we bridge this London OU and then confirm it at the London high, and we breach the Asia, we alert the Asia midline, and we breach the previous day midpoint, we have to consider the thought process. Where is it going? Is it going to net up here for the high of the day, or is momentum completely shifting? Right? Because what I just talked about is what makes people blow their accounts. Right? We know we don't trade off of this chart and what we're doing here. This is just for us to see the different scenarios that plays out, right? And people who continually take counter trend trades, it tells me that they're not thinking. There's nothing wrong with counter trend trading, but it tells me that unless you're grabbing, like when you're counter trend trading, you take profits quicker, right? Because you know everything's skewed against you.
Yeah.
But for the people who can't see, hey, we breached London midline, we take out Asia London high, is momentum completely shifting? Is this really a counter trend buy here, or is this momentum is shifting? We put the low of the day scenario in buy, right? And then if we do take out Friday's high of the day, right? What clue from the weekly chart does that tell us that this has a high probability of being a low of the week, right? Because remember, that's why we have this little Sunday opening price. We have Tuesday for the DR community to guide us, to kind of hold our hands and tell us where the low of the week is obvious at.
Yeah.
So it all ties together. Okay, so now let's put the rest of the probabilities on. So let's go with 5 to the downside.
So 5 to the downside, I haven't changed the settings exactly as we are, is 66%. 66.
All right. And then 8.
47%.
So now we see that there is higher probability from what price is done for us to come down and touch the -8 than there is for us to go up and touch the +5. What was the -8? 47?
47%, yeah.
All right. So now, which one of these falls within the daily range? We know that +1 falls within the daily range. -5 falls within the daily range. They all fall within the weekly range because we're a brand new week.
Yeah.
So now we're going to do our distros. Right? If our average daily range is 1.36 for the average 10-day range. All right, now we're going to do our 4 to 8. And we need to go to the 5-minute chart because we don't need to see 46 Mondays ago. We need to see 15, the quarter average for the 4 to 8 range.
0.48 I have.
All right. Now we're going to do 8 to 12. What do you have?
1.16.
All right, now we're going to do 12 to 16.
0.88.
All right, now let's mount these. right now, this would be from 4 o'clock low to 8. This is the average range.
Yeah.
And it should be at 4.8. Because this is giving us that realistic expectation for movement, right? All right, and we said as we are now, let's zoom in a little bit. We know that this structure stat 1, 85% is a probability and this 60% probability. We know that as we speak right now, the probabilities are to the downside, right? So we're going to continue in this day, because of the day, we're going to look at a high of the day scenario. Well, what's going to net the high of the day? Can we say that this Asia 2000 could be the high of the day? Well, with the fact that it rejected off a previous day midpoint, yes, it could. However, remember what we talked about 1 minute.
That's your.
Remember, high of the days and low of the days have destruction and instant recovery. This doesn't look like a destruction and instant recovery. Well, it kind of does for that session. But we also know that these have probabilities to the upside, so we have to incorporate that, right?
Yeah.
We know that based off of what variables Asia has done so far, that the highest probable scenario is that 9:30 to 10:30 has a 59% probability of being below this London high, and then we have a 49% long at 10:30, right? Doesn't mean it's going to stay true for the whole day. We just know that's what the probabilities are, right? So it is very realistic to think that this is what our daily profile can look like.
Yeah.
From a statistical standpoint.
Yeah.
Now, with that being said, I know that you are working on a daily statistical project for me and for us. Would that line up with anything we're doing here?
Too early to report.
Okay.
I'm not. I can actually give me a second.
So while he's doing that, yes, this is the highest probable statistical daily profile that we have. Doesn't mean it's going to happen and it has to happen, right? However, as price is booking, all right, we are going to be paying attention to these OU lines, and like we talked about, is momentum shifting? Because if momentum shifts and takes out this Asia OU and this London OU, then these probabilities all are shifting to scenario 2, right? Does that make sense to the audience? And we're going to start thinking about the markets delivering in the scenario 2, right? But until we do that, we have to think of the market from the highest probable scenario, which is scenario 1. Are there any questions in the audience?
Just waiting for this to start up.
All right. Good morning. Good luck, FX. Dude, I'm so glad I don't trade the FX. No offense. I used to trade FX. There's nothing wrong with it, honestly. Just like any other thing that you trade, you need a repeatable workflow process, risk management, and, stick to your game plan.
Okay, should have something for you in a second.
All right, so while he's doing that, let's talk about this, right? We use these hourly boxes to tell us as we're coming to high probabilities areas, right? Are we going to reverse? And does the hourlies confirm it? And we use the 5-9 box. So let's. Sorry, I get distracted. Let me reorganize my thoughts, right? So, all right. So on this Friday, we had this being structure 1 right here, right? So structure probability 1 was right here. Right? And we knew that had an 89% probability of being returned 2, right? From 1600, right? And so we came up into it. And so we'd be looking at this chart right here to the right to say, hey, guess what? We're coming up to a high probability level, right? Now what we're going to do is we're going to take these are our hourly boxes, and the blue lines are the 5-9s, right? Those little wolves are a measurement of kurtosis distribution to show us displacement, proper displacement when we hit it. But right now we're going to say, hey, like, did we reverse? Nope, we didn't, because we're stepping above this 5-9 box and we're finding support on. So it hasn't reversed yet. New hour opens, right? We can see that momentum for the hourlies are still the upside. But then the 5-9 box happens and we start stepping below it, finding rejection, stepping below it, finding rejection. And then finally we get below previous hour midpoint, right? And now we can say this high probable reversal right here is now in, right? And however you enter and trade, that's up to you, right? But you can start looking for selling the rip kind of material. You know that if we're in a range of market based off these 5-9 boxes where the mids are lining up and the 5-9s are going up, down, right? That's a consolidation of building value area, accumulation area. I don't know. There's so many different lingos for it nowadays, right? But we know in that kind of trading environment, we want to be, trading. Like I always use 10 micro contracts. We know once we identify that we're in the range, we want to buy the low part of the range. If we have a high probability area to the upside, we know that we don't want to be the seller of the range. We want to be the buyer of the range because we're targeting that high probability, but we're not going to hang on to the position because we're not in a proper trending market. So what we do is we buy low and we sell low hanging fruit, right? So previous hour mid, previous hour high, right? Buy it, previous hour mid, previous hour high, until we get to that high probability area. Once we get to that high probability area, we're looking for that reversal. So right here, right, it's okay to start building a position, especially at 9:30. Once we saw that, we rejected taking out previous hour mid. We stepped below and found rejection from the 5-9 box. This is when I enter a fourth of my position, right? And then I use the next couple hours. They better show me a trending environment where we're rejecting previous hour mid, we're stepping below 5-9 box and finding rejection. So right here, I would add a couple more contracts. And right here, I would add a couple more contracts, and then I'll be targeting a high probability level down here to take those completely off.
I've just dropped something. So the data that I have and is quite evenly spread. Obviously, there's a kind of a bell curve distribution there, but it's loaded to the lower percentages, as I guess you kind of expect, and that's based upon where we find ourselves right now. So the 5 that I highlighted is roughly where we are now in terms of price. So it suggests that there could be a little bit more to go there. But the caveat with this, there's a few caveats, but the main caveat right now is in terms of the comparison of data. When I captured the daily candle data, I only went back to 2014, whereas I'm filtering on model our London or Asia sessions is to 2008. I need to acquire those 6 years to make those two data sets equal, so that when you filter, it's one for one, if you know what I mean.
Yeah. Yep, definitely know what you mean.
It's coming.
Sorry. 62%. 43%. 87%. Okay. All right. So with that being said, we see that the highest probable trade here, we talked about how we did it, how we used the higher time frames, how we plotted all this, and we even started going into how we use the hourlies and the 5 and 9 boxes to orientate ourselves the live price. Because whenever you guys use any step of historical data, you have to have a live price component to see how the market's responding to the historical data, right? That's the critical factor that a lot of people mess up. They just say, hey guys, like this has an 82% probability. That's guaranteed. Well, you need these alerts and confirmations that tell you that live price is confirming that that is what is in sight. But with that being said, I do have to jump. Hopefully you guys got something out of this, and have a good day.